Right, so it's the start of the next week, whatever the date is. I don't know. Here we go. What am I seeing here in the markets at the moment? Just a quick one: equities and gold and the Aussie currency. That's the story. It's plain and simple. That's number one. Number two, if it's going to pull back. And look, really, that at a stretch, that would be the pullback, if it is or when it does have a sizable correction. It doesn't really correspond to any fibos on that one around this leg. No, not really. There's no obvious levels for it to pull back on the fibos, which to me is kind of says got further to run. That's a short version. No signs of weakness apart from the overbought RSI, and it is struggling a little bit here on the dailies. Let's look at the candles. Yeah, a little bit of a struggle there, but I think the odds are pull back to there. If it's to there, then that would be a serious one. This, obviously, the further it goes, the lower the probability that it's going to come back to this level here, but it is still on my radar. That's the S&P. Now, gold, look at gold actually. That's the story of the week, really. Where like on the dailies, it's kind of broken that trend. I kind of look at gold a bit more on the weeklies, just because of the way it is. But on the weeklies, like, it's broken up as well. And this is the level of support that I'm seeing. Another one down there. Now, I am a little bit skeptical on this for a couple of reasons. One is, back here when it had a big top, it had the same kind of breakout. Everyone's getting very excited there, and it broke up and it couldn't hold. Here, see, it's done the same thing. I mean, I kind of saw it doing the same thing there. Maybe it's doing the same thing here. I'm a bit skeptical of this rally, so I'm not going long. Now, the other reason why I'm skeptical is when we look at what happened here, 3rd of August 2020, that high, and we look at this one here. What's that one? 29th of August. Remember those dates, 29th of August. There, that's the ding-dong high of 2011. 20th of August, or 3rd of August 2020. And we look at the US 2 years. This is what we see on those dates, right? That one, the 29th of August 2011. And this one, the 3rd of August 2020. So when the 2 years hits its like little kind of just about ding-dong low, right, down there, and here, right, that's when we see the high in gold, right? Now, when we look at this date here, for example, that's the 1st of April 2013, when the yield starts to rise, right? 1st of April 2013. Let's go back to gold. Look at that date, 1st of April 2013. 1st of April 2013, right, yeah, okay. So when the 2-year yield starts to rise, that is the start of and that was a big gap down, and it sent gold into fall from the high, $1,800 down to $1,000, $800, right? Massive fall. Now, the other thing that we can see when we go back to the yields is here, when it topped out here and it started to turn, that's the 29th of October 2018. So let's remember that one, 29th of October 2018. Where's that one on here? 29th of October 2018. Right. Okay. So here we go. So what we've got here is we've got a record low in yields here. Okay. Then when those yields start to, and then we have this kind of pattern while we've got those record lows, you know, choppy, 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 blah. Then we've got a breakdown when yields start to turn. When yields top, right, and then they start to go the other way, right, it's going from high to low, this is when gold really started its leg up to the high, and so as gold went up, that went up as yields went down, topped once yields go low, once yields hit their lows, and it's done this same pattern here and here as we've been crawling along the bottom of those yields. So gold had a run up here on a few things. One was fundamentally lower yields, right? You know, that 2 year, right? That also fuels inflation expectations and lower real yields. Okay, so it's a combination of the actual, the nominals and the and inflation to get the real yields. So that fueled that. It had this big leg up, of course, because of COVID and the fear. Right? Now those factors have faded away. Inflation hasn't though, but I would argue that inflation was, and what we're seeing now, the inflation we're seeing now, that was kind of priced into this move here, because as those yields go down, everyone's saying, well, this is inflationary, right? This is good for gold, and so people are buying gold, and as they've hit their low, everyone said, right, well, that's it. We're starting to look through the curve and we're seeing this. Now, just as here, you know, there were some inflation numbers coming out. I've been kind of tracked them, and that kind of fuels a leap in gold. But really, where is inflation going to go to? Where is the Fed going to let it go to? Okay, and are those yields, where are they going to go to? Those 2 year yields. Okay, so that's why I'm skeptical of this move in gold. And in fact, gold is still lagging this move higher in yields. And to me, that kind of says that it's the rally is a little bit flawed. Okay, because we haven't seen a big pullback. I think we've seen some little pullbacks like in here, like these, you know, these breakdowns. You know, like there was one in February, I think, you know. There was another one later on. I'll look at that in more depth. But that's why I'm not convinced about the breakout in gold. So that's gold and the yields. Watch the yields. Don't just get the gold bug, right? A currency, I've been trading the currency a little bit, and I'm seeing this, right? Seeing that kind of channel. I'm also seeing this little channel here, right? So I shorted gold up here. I squared it up. Might go short again if it has a little bit of a rebound. I think it's still going to target this. So we're seeing a bit of a bear flag within a potential bull flag. Right there. I'm a bit wary of the currency. It could really drop a fair bit. So I'm still playing it from a short perspective. And then the Aussie market, Aussie share market, what am I seeing there? Not dissimilar to the US market. We've got a nice big channel there. We obviously haven't regained those new highs, and there is a level through here that is looking an interesting make or break. That one I'd call a red line in the sand for the Aussie. Yeah, let's go down the 4 hourly, see what that looks like. I'd been short the futures here, again, I've did it a couple of times, squared up. Haven't had another shot, basically selling it out at like this 74.50 level, or wherever I can get set on the day to that. That's going to be an interesting one to watch in the Australian market to see if that breaks. That is the key level there. So that's pretty much it, the wrap for the week. The only thing I've got on my horizon for this week, of course, is that we're coming up to the 19th, the 19th, the 19th, and the 19th, and the 19th, where they did it like 5 times in a row. That seller of the 17th, 18th, and then recovery on the 19th, which they didn't come through this past month. Never know your luck in a big city. They might come through this week just because it's at a higher level, depending on how the algos work. So I'll be watching that quite carefully. So there we go. So it's all looking positive in the S&P. The gold breakout, it's broken out really quite strongly, but it's on the 4-layer. But to me, it is it's a little bit fragile because of the 2-year yields. I've been short the bonds, the 10s, the 3s, the 2s in Australia and the US, depending on the tenor. You know, these yields, they have really ticked up, and they're, to me, it's looking like they could still have a good leg up, and if they do, that is going to be bad for gold, because they could quite easily tick to here. This would be the level here that I would be looking at. Okay, that's another 50 points. That would be first stop, a definite red line. The second stop would be like the level through here, and that would start, even as inflation returns to normal as their target, and the Fed will eventually make sure it returns to normal. That's where, and saying normally is like 2 to 3%, these 2 yields will go to 3%. That will be bad for gold. Remember, when it hit here, when it started breaking, this was like an $800 drop in gold, right, from $1,800 to $800, more than 50%. We've started there. If you're going to be long gold, it's the wrong time. The time to be long gold was here when rates were doing that. Is not the right time to go wrong gold, unless you really think inflation is crazy. Look, that's it for the week. Have a good one. We'll catch you later. Ciao.